Inflation is likely to linger like a bad hangover in 2022, something Wednesday's consumer price index may go a long way to reinforce. So what will that mean to stocks? Amanda Agati is the Chief Investment Officer at PNC Financial Services and joins us now. Amanda, always nice to see you here. Why do you think the market is shrugging off these high inflationary readings, which is likely to be on display later this week? And how long could it continue to do this?
Well, it's great to see all of you. Thanks so much for having me. We're definitely in the transitory inflation camp. And I think it really comes back to this idea that the pandemic is still, like it or not, a little bit in the driver's seat as it relates to the inflation backdrop, as it relates to supply chain disruptions. We're really seeing this waving sort of effect of different aspects of the economy and input costs rising, but not everything is moving at the same pace. Just as fast as we saw lumber, corn, and other prices kind of fade here, we've seen the baton hand off to other types of input costs, energy in particular, and a number of others. And so what we're seeing in the market is kind of this recognition that this is going to be a bit more transitory and fleeting. If the market felt that the inflation backdrop was going to run so red hot that it was going to force the Fed's hand to make a meaningful policy shift soon, I think we'd be seeing a very different market backdrop. We've seen a rotation back to larger, growthier exposures, and we've seen rates start to fall here more recently. And so that's the market confirming, at least from our perspective, that inflation is likely to be transitory, maybe a little bit longer sustained than what everybody would like to see, but that it's not going to run so red hot that it forces the Fed's hand too soon.
Amanda, this is Emily. As you take a look at third quarter earnings results, of course, we've seen those grow by nearly 40% compared to last year. And you highlighted that we've seen a somewhat concentrated EPS drivers this quarter, with this really coming from energy and tech. What do you think has been driving this outperformance in these sectors? And do you think those factors can continue into the next couple of quarters?
Well, what's interesting is that we've had fairly narrow and concentrated growth drivers all year. The baton has shifted a little bit from quarter to quarter and sector to sector. Believe it or not, coming into Q3 earnings season, it wasn't necessarily energy and tech that were supposed to be the leaders. It was supposed to be energy and industrials. And then, of course, we saw the bottom fall out of expectations for the industrial sector, as we're still hashtag not out of the woods yet as it relates to the reopening and the pandemic. And some of those more cyclical areas are still under pressure. When you look at energy and tech, though, I mean, if you think about where commodity prices were at this time last year, complete 180. And so certainly the commodity price backdrop is driving significant expectations for energy and growth in that area. But tech, I have to say, it's a little bit of a contrarian view, but I keep sticking with this story that tech is going to continue to be a growth driver for the market going forward. They've been able to power right through the pandemic, effectively using the pandemic to their advantage. And so the fundamental chops in tech just continue to be so strong. They don't even have that easy year-over-year comparison, yet they're still able to post really strong results. And so even at these valuations, we think the underlying fundamentals will keep those powered going into the new year.
Hey, Amanda, it's Julie here. I want to circle back to energy for just a second, not so much as it relates to the energy sector itself, but as it feeds back into this whole inflation story. You know, energy prices obviously are volatile also, and they tend to be transitory. But we have seen pretty persistent higher oil prices here, and really not, unlike with some of the other supply chain issues, there's not necessarily anything that's going to be the brakes here. So not necessarily as it feeds into the long-term inflation, but as it pertains to company margins and also a tax on the consumer, how much is that going to be an issue going forward?
Well, I do think there is a bit of a breaking point. That sounds like a strong statement, not that we think it's strong enough to break the cycle by any means, but I do think there is this natural kind of limit to how far we see energy prices go before it does have that negative feedback loop on growth. I think what's interesting here is that OPEC has managed to get their act together from a production agreement perspective, and that is not the norm. That is the exception. And so while we've managed to see some stability in terms of policy out of that group, we don't think that will necessarily stay the case. We'll start to see some disruptions and disconnects going forward. And so that may fundamentally shift the backdrop in terms of the supply and demand dynamics. And so we'll have to see how things play out there. The other thing that I think is a natural governor on how far and how fast prices can move is what's happening with North American shale. The break-even price is about $55 a barrel. And so to the extent that prices stay sustained well above that, we're going to see North American shale production ramp. So I think that's kind of the governor. That's not necessarily the breaking point, but that is the ability to kind of put the brakes on how far this energy price rally can go here. And so we're watching production there very, very closely. Very different dynamic than in past cycles. And we really haven't seen demand come in a big way. So it's much more of a supply side story than prior cycles. And I think that will make it a little bit different, even though I recognize dangerous words, a little bit different this time.
On the policy front, Amanda, the infrastructure plan, do you see that as a major catalyst to the broad market, or is this just something that's confined to these infrastructure stocks like a Caterpillar or Cummins that are popping this morning?
I would say very narrow, if not neutral, effect on the market. So there's no question that the need is significant. I'm all in on the idea of traditional and some of this new age infrastructure investment in EV infrastructure, broadband, 5G, et cetera. Absolutely, the need is significant. American Society of Civil Engineers gave us a C-. There's no reason in the world why we should be that behind in terms of our infrastructure investment. But when you look at the package, headlines say 1.2 trillion. But the new spend is really only $550 billion. I say only. It's still got a B behind it. So still significant there. But it's not likely to move the needle in as a significant of a way as what we may have initially expected from the Biden proposals back in the spring. The other thing that's notable is the spending is spread out over a really long horizon, 8+ years. And so while the need is significant and there's a lot of opportunity to build out infrastructure and upgrade our infrastructure, we don't think it moves the needle in terms of significant economic growth. It's not going to give us that shot in the arm that I think everybody is expecting. Yes, that was a terrible pun, but I did it to you anyway. We're not expecting to see this really significant move in terms of economic growth. And so net, we don't think that that's going to add fuel to the inflationary fire here in the short run.
I can't wait 8 years, Amanda, for my roads to be fixed. My new rims are chewed up. I can't take it anymore. Amanda Agati, Chief Investment Officer of PNC Financial Services. Always good to see you.